Welcome to the Stock Market Palantir. Today we are going to talk about AIMAX. The price action we saw in Autonomics Medical, ticker AIMAX, on November 17th, 2025 was, well, it was really something else. It's a fascinating case study. We saw this microcap stock just surge by nearly 95% on untruly astronomical volume, 23.6 million shares traded.
An incredible day.
Exactly. And we both agree that two powerful forces met here. You had compelling, positive clinical data, and you had critically low liquidity. So the central question for us today is, what was the primary driver? Was this surge a justified fundamental revaluation of a breakthrough technology? Or was it, primarily a mechanical anomaly from an exploited supply vacuum? I'm firmly in the camp that this was a fundamental validation that demanded a radical repricing.
And that's a strong way to frame it, but I really have to hold that the volatility, the near 100% price move, was fundamentally a mechanical event. The news, it provided the spark, sure, but the company's own previous actions, the supply structure, that's what created the volatility tinderbox. What we saw was a classic low-float squeeze, just amplified by modern trading.
Okay, well, let's ground this in the clinical reality first. AIMAX is a development-stage medtech firm. Before this surge, its valuation was extremely low, hovering around a $5 million market cap. Its value is entirely derived from the future potential of its platform. They call it a GPS for the nervous system.
Right?
Which basically means it's a transvascular system designed to precisely sense, treat, and then verify nerve activity, all through blood vessels. It could potentially replace some really complex surgeries or chronic medications. So the November 17th press release gave us clinically meaningful proof-of-concept data from their first-in-human study. The validation was overwhelming. Late-stage patients saw a symptom improvement of 32.48 points at 4 to 6 weeks. And importantly, all the 3-month quality of life results surpassed the clinically meaningful change threshold set by the EORTC, that's the European Organization for Research and Treatment of Cancer. It's a global standard. So this was a powerful de-risking event that cemented the company's opioid replacement narrative that justifies a massive re-rating.
I agree, the clinical data was undeniably positive. A home run, really, no question about it. But we have to look very closely at the batter's box itself. The price action was completely, and I mean completely, disproportionate to that news because of the pre-existing mechanical conditions. I mean, think about the scale here. If that exact same news hit a similar company with a standard float, say 25 million shares, we might see a healthy 20% pop.
Maybe.
The reason we saw 95% is the 1-for-20 reverse stock split they completed back in October of 2024. This action just artificially crushed the outstanding shares from around 23 million down to just 1.15 million. That's a state of severe engineered illiquidity. So when demand hit that vacuum, the outcome was inevitable. On that day, 23.62 million shares traded. That means the entire share count turned over 20.5 times in one day. That is the absolute signature of a low-float squeeze. The news was the catalyst, yes, but the illiquidity was the necessary precondition.
Okay.
Your point about the platform's potential is strong. The sense, treat, verify validation is absolutely significant for the future. But how do we reconcile that long-term vision with a single trading day that saw the stock turn over 20 times? A stock with 23 million shares simply would not have seen this price velocity. The mechanical setup was the absolute necessary precondition for this kind of explosive result. The pricing mechanism, I would argue, just broke down.
Well, I'm just not convinced that focusing purely on the share count is sufficient. It really minimizes the qualitative shift in the valuation. I mean, for a company at this stage, valuation is a probability calculation. Before this data, the market might have assigned what, a 5% chance of success across all their targets? This validation proves the platform works in humans, dramatically increasing that probability, maybe to 25 or 30%. That kind of massive shift demands a significant jump in market cap. The low float is just the structure that allowed the repricing to happen instantly, efficiently, reflecting the new fundamental reality.
But 100%
Instantly?
And it wasn't just about pain management. It demonstrated the mechanism for huge fields like cardiology and renal denervation. The potential shift is exponential, not linear. And let's also talk about market integrity here for a second. The analysis confirms this surge was organic. We aren't looking at a meme stock event. There was no evidence of a coordinated social media push, no big WSB campaign, and crucially, we didn't see institutional manipulation, no hidden block trades and dark pools. The fact that the event originated purely from a corporate press release, followed by transparent trading, it really supports the view that this was a rational reaction to verifiable clinical success.
That's a really interesting analysis of what didn't happen. But I would argue the absence of that kind of manipulation just illuminates the real amplifier here, the modern retail trading ecosystem. You could call it the retail FOMO engine. The analysis shows the news hit around 7 a.m. In the pre-market, algorithms and skilled day traders instantly screened for two things: the positive clinical language, clinically meaningful, and the 1.15 million share float.
Okay.
Those initial algorithmic buys caused that rapid pre-market gap up. So when the NASDAQ opened, the stock was already flying. And that placed AMIX right at the top of every major retail platform's top gainers list. That visibility triggered a cascade of retail demand. It was pure fear of missing out. They were chasing momentum into a stock with no available supply. The low float was the prerequisite that let that initial algorithmic bump become visible enough to trigger the whole retail cascade.
Yet, the most tangible evidence supporting the fundamental valuation shift is the strategic outcome for the company itself, the creation of a crucial capital window. As a small, cash-burning R&D company, this price appreciation validated the science, and it enabled management to use its existing financing structure, the ATM, the at-market issue and sales agreement, to raise capital. Selling shares at $1.50 post-surge is just dramatically better than at 73 cents pre-surge. This directly enables them to fund their crucial 2026 multi-center study. It confirms the market recognized the underlying value shift.
I see that point, though. I'd frame it very differently. The company is expertly leveraging a liquidity anomaly. The surge allowed them to raise capital, absolutely, but that capital raise itself demonstrates how fragile that price was. The focus immediately shifts to exploiting the liquidity mechanism, that staggering 20.5 times turnover, by selling new shares into the high demand created by the squeeze. So the question becomes, what's the true price a week later, once that squeeze demand is gone and the company has added millions of new shares to the float? The mechanics created the financing opportunity, not just the data.
But that financing is essential for survival. If the market saw only an anomaly, that capital window would slam shut instantly. The buying pressure would vanish. The fact that demand persisted long enough for them to execute the ATM shows that investors agreed the platform validation had created a substantial, durable floor under the stock, regardless of the initial volatility. They're investing in the de-risked R&D pipeline. The low float accelerated the price discovery, yes, but the science determined the new level.
I'd have to counter that the low float distorted price discovery entirely. It didn't accelerate it, it inflated it. The subsequent capital raise, while pragmatic for the company, is just evidence that the initial surge was unsustainable and had to be offset by increasing supply. The price movement was dictated by the constraint of 1.15 million shares, not the infinite potential of their platform. It was a short-term mechanical manifestation of supply meeting news.
So to summarize my position, this event was fundamentally driven by overwhelming clinical data that significantly de-risked a novel, platform-based technology addressing critical needs, especially for non-opioid pain solutions. The low float was merely a structural feature that allowed for an efficient, dramatic, and instantaneous repricing.
And I maintain that while the core data was the necessary catalyst, the actual volatility, the magnitude, and the dizzying speed of that 95% move were dictated by a mechanical reality. The reverse split created an extreme low-float squeeze amplified by algorithmic identification and then the retail momentum cascade. I think understanding this intersection of strong fundamentals and severe mechanics is really the key to appreciating the AIMAX case study.
So we'll leave the listener to weigh the evidence and determine whether the price explosion was primarily a reflection of the science or a function of the supply constraints.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.